Good morning, ladies and gentlemen. Welcome back to our interview series titled Winning Over Volatility, where we discuss how investors like you can navigate the current economic crisis. In today's episode, we evaluate banking and PSU funds. We are joined by Mr. Mahendra Jajoo, Chief Investment Officer Fixed Income at Mirae Asset Investment Managers India Private Limited. Welcome, Mr. Jajoo. It's wonderful to have you here on the show again. We will be taking up a few questions from LiveMin's social media audiences at the end. So banking and PSU funds are considered to be one of the safest forms of investment. They're even considered to be a good alternative to fixed deposits. Are they still safe bets in lieu of the current economic crisis that we are dealing with?
Absolutely, because if you look at the composition of the portfolio of the PSU and banking debt funds, they are investing primarily in the public sector papers and the banking papers. And these are the two safest segments of the debt market, primarily because the PSUs are owned by the government of India or in some cases the state governments, and they are the people who have the ability to raise taxes, etc. So they are the safest. Historical experience will also suggest that. In case of the banks, they are governed very, very tightly by the Reserve Bank of India. They are clearly, on the one hand, amongst the safest segment, and on the other end of the spectrum, we have been besieged by a series of credit defaults over the last couple of years. We have seen the number of events in terms of the credit default, which we have not witnessed historically. And the combination of these two means that at this point in time, the PSU and banking debt fund, in terms of the credit quality, is amongst the safest one. And then, if you notice the minute details, even in case of a banking and a PSU debt fund, 20% up to 20% can be invested in non-PSU and non-banking papers. That is the flexibility that banking and PSU debt fund has in terms of the SEBI guideline.
So the recent debt fund crisis has adversely affected investors' sentiments about debt funds in general. So do you think the banking and PSU funds automatically qualify as a natural and safe choice in such a scenario?
There is a range of funds that the industry offers. So the PSU and banking fund is one of the safest fund in terms of the credit quality. Right. But when an investor is looking to invest, he is looking not only at the safety, he is also looking at the return, he is also looking at the liquidity, etc. Now, PSU and banking fund is a unique category where the fund manager has limitations on the kind of credit quality that he can compromise with, but the maturity range is fully open. There is no prescription in terms of what maturity you can invest in. And if you look at the current composition of the broad range of the funds in this category, broadly, people are invested between 2 to 5 year range of average maturity. And we are in a cycle where the interest rates have gone down dramatically, and the wider expectation is that the interest rates will continue to ease for some time to come. So I would say that if the investor has a long-term investment horizon, if he has a patience with a bit of volatility, then this is a good category of funds to invest.
So that brings me to my next question. You mentioned interest rate. Though relatively less risky, these funds are affected by interest rate movements. Why and how do interest rates affect the performance of banking and PSU funds? And how should, as an investor, one navigate through this scenario?
So interest rates are generally cyclical in nature. So if the interest rates go up, then it affects the market value of the investment of the portfolio, and the NAV comes down, resulting in a negative return for the investor or a dip in the return, depending on how severe the interest rate movement is. But as I said, that right now, in the last 1 year, we have seen the interest rates go down. Therefore, we have not seen the other side of the coin where the NAVs can be negative for 3 months, 6 months, 1 year. And therefore, there is a sense that, these funds are the solution to every problem, which is why I repeatedly highlight that the investors should have the adequate investment horizon and the willingness to absorb some bit of liquidity, because there's no free lunch. You can't outperform the bank FDs by seeking the same safety that a bank FD gives in terms of a prefixed rate of return or no volatility in the return.
I mean, just to sort of add on from the last question, do you think, there's talk that the fiscal deficit this time might go up as high as 7-8%? That's very high. Now, technically, there is no rule as to how much fiscal deficit can go to. But there is something called fiscal prudence, a healthy fiscal deficit. We know the entire sort of world, most economies are in a state where government spending has to be boosted up. A lot more is needed. But then, on the other hand, that also results in negative sovereign sort of debt, ratings coming down. How do you view this situation?
So I think fiscal prudence is a very important factor, but the fiscal prudence has to be defined in a broader framework. Fiscal prudence just does not mean that you don't spend or you don't commit fiscal deficit. You have to look at the broader context. When the fiscal profligacy is due to the misplaced priorities of the government, or if there is a lot of wastage, or if the investment of the money is into non-productive or non-long-term projects, then that fiscal deficit is undesirable. At the same time, in the current situation, if you do not provide financial assistance to the economy, if you do not give relief and assistance to the people who are suffering for no fault of theirs, but because of a natural crisis, then the whole question of the survival comes into being. So therefore, I think it is not a question of fiscal deficit being always wrong. In this current environment, if you look at not only India, but all over the world, every central bank is bending backwards to provide as much assistance as is required. So I don't think that there is too much concern on the fiscal deficit, because it is going for a purpose.
Coming back to our subject of banking and PSU funds, my last question for you before we move on to the social media questions that we have received. For those, and I think you've partially answered this already, but if you want to sort of tackle it again, for those looking to invest in banking and PSU funds for the first time, what are the things that they should consider in terms of their risk profile and their basket sort of portfolio of investments? What is your recommendation?
So, although this is something that a wealth advisor is more equipped or more able to respond, but at a general level, I think the investors will have liquidity or the surplus to invest in a staggered way. There are some people, for example, if you look at me, I'm a salaried person. I earn some surplus every month after meeting my requirements. So, and if I do a reasonable job, I'll keep my job for a relatively good long period of time. So I will have this surplus every month after month. Therefore, my investment style will be different from someone who has got a lump sum money on retirement or on some from some other source. Therefore, people have to look at what is the source of their investment requirement and for how long that investment will be kept. And then people have to also accept that if you invest in a market related product which has interest rate volatility, then they have to accept that there will be some up and down swings in the NAV. The only answer to that is to invest for long term, where you can complete one interest rate cycle, because there are a number of people who are making a strong argument today that once the situation comes back to normal, the interest rates will again go up because inflation will go up, etc. We don't know what will happen. So the very important aspect of our investment strategy that I want to highlight is the flexible investment strategy. One should have flexibility to change its investment output. There are two basic misconceptions about investing in debt. One is people think they need to know what will happen to interest rates in the next 3 years. The fact of the matter is that we don't even know what will happen at 4 o'clock today, or what will happen in the next 3 months tomorrow, in 3 months from now. So I think the focus has to shift away from trying to predict the future to manage the future in a practical way. And then the second is the cardinal principle of investing in debt is that you need to have a high quality of the portfolio, because the only risk that one has in debt is that if you lend money to someone and it doesn't pay you back in time. So as long as you avoid aggressive credit risk.
We're moving to the last part of our discussion where we take up a few questions from social media. The first question is from Shagufta Ahmed Joseph, and she asks, are banking and PSU funds a good alternative to a savings bank account? Okay.
My view is that any debt fund, even a liquid fund, is a better alternative to a fixed deposit or a savings account because, I mean, the savings account is for people who have no use for the money. So they just dump it in the savings account. Is savings account even an investment option? Right? That is the basic question they need to answer because ultimately the returns will come from a market related product. And all the debt mutual funds are market related product. In my view, and as far as I have looked at the numbers for the last 1 year, 5 year, 10 year, 25 year, the debt mutual funds of all types have given returns better than the corresponding bank fixed deposits.
So the last question, sir. This is from Hemant Sandhu on social media. Uh, how liquid is PSU fund as an asset, and what are the drawbacks compared to private securities? Also, what is the correct time to step into the PSU fund market?
Well, to answer the second question first, I think it is a well established dictum that timing the market is futile. Uh, as I said just now, that 3 months back before the coronavirus, we were a bit negative on the fixed income because our economic parameters were not looking very encouraging. And then the things changed so dramatically. So, in terms of timing, I think when the investor has money, that is the best time to invest, and it is the best time to invest if he has the time horizon to sit through a market cycle. That is what is more important. I personally think that uh, timing the market has never worked.
And the first part of the question, sir, basically, how liquid is PSU fund as an asset, and what are the drawbacks compared to private securities?
Again, when you are investing in a fund versus investing in an individual security or private security, it is the same risk of investing in a diversified pool versus a single asset. So I personally think that the debt market is very liquid in the banking and the PSU space because there are so many banks, so many insurance companies, so many FPIs who are all investing in that space. When someone is again investing in a debt fund, the liquidity is also taken care from a pool perspective that as far as the investor is concerned, he just needs to sign a redemption slip. And I think there is a 25-year history of the debt mutual funds in India where in most cases people have met the redemptions successfully. So because of the pooled nature of the investments in a debt mutual fund, the individual does not have to worry about individual securities liquidity or lack of it. When you are investing in a single security, one has to have his own ability to conduct a full-scale due diligence and then invest.
Right, right.
So it's a classic impact of diversified portfolio versus a single stock portfolio.
So thank you. That's all for today. Thanks everybody for tuning in. Stay safe and keep watching.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.